The Rolex myth is dead. For years, the crown was seen as an infallible symbol of ever-appreciating value. It was an asset class, a speculative investment where waitlists stretched for years and secondary market prices soared to unimaginable levels. But that engine has stalled. In China, the brand's single most important market, the boom has reversed into a brutal, precipitous decline. They are dumping their Rolexes. And today we're breaking down the data on why they're selling and why you should probably be thinking about it too. If you value straightforward analysis on the luxury market, subscribe to Opulent Oasis, like this video, and hit the notification bell. This isn't a minor correction, it is a full-blown crisis. For 3 consecutive years after the pandemic, the Swiss watch industry experienced an unprecedented boom. This surge was built on the voracious appetite of one market: Greater China, which accounted for nearly a third of all Swiss watch sales by value. Now that foundation is gone. In the first half of 2024, Swiss watch exports to mainland China plummeted by 21.6%. The traditionally robust market of Hong Kong fell by nearly 20%. The luxury giants are feeling it. Richemont, the owner of brands like Cartier, reported a 27% drop in its Greater China sales in the first quarter of 2024. Swatch Group, which owns Omega, saw its China sales plunge by an even more dramatic 30% in the first half of the year. This led to an eye-watering 70% drop in its operating profit. This is a stunning reversal of fortune from 2023, when Swiss watch exports to China had more than doubled. The Gilded Age has ended. So why the sudden collapse? It's not one single cause, but a perfect storm of economic, political, and social forces. First, the economic engine stalled. Consumer confidence in China is at rock bottom. A 2024 report by Bain & Company identified low confidence as the primary driver for the estimated 18 to 20% decline in China's mainland luxury market, a contraction that pushed sales figures all the way back to 2020 levels. This is backed up by a Morgan Stanley survey from early 2025, which found that the outlook for spending in China had fallen to its lowest level since the pandemic, with 60% of respondents planning to reduce their spending. But the real problem, the one that truly matters, is the collapse of the country's property sector. For years, real estate served as the primary store of wealth for a vast portion of China's affluent and upper-middle-class households. That wealth has been erased, creating a severe liquidity crunch. Wealthy Chinese tycoons and property developers are now selling their luxury homes in Hong Kong at fire sale prices. Discounts of 35% are common, with some properties selling for up to 50% less than their peak values. This reveals the crucial link. During the boom years, luxury watches, particularly steel Rolex models, were perceived as a highly liquid, easily transportable and appreciating asset, a form of hard currency. When your primary and far larger store of wealth, your real estate, becomes illiquid and loses value, you sell your secondary assets to raise necessary funds. People aren't selling Rolexes because they suddenly changed their tastes. They are selling because of a balance sheet crisis. Compounding this, a persistent high rate of unemployment among recent graduates has shrunk the crucial aspirational consumer base that luxury brands depend on for future growth. Layered on top of this economic hardship is a powerful top-down political pressure. President Xi Jinping's administration has been promoting the concept of common prosperity, a political doctrine aimed at reducing income inequality and discouraging ostentatious displays of wealth. This is not just rhetoric. The government's long-running anti-corruption campaign has had a severe effect on the luxury watch market. High-end timepieces were notoriously used as a form of gift or bribe in Chinese politics and business. The government's crackdown made this practice perilous. One academic study found that the campaign led to a reduction in the importation of conspicuous luxury goods, such as jewelry, by approximately 55%. This was amplified by public participation, as bloggers and citizens began to identify and publicly shame officials seen wearing expensive watches that were clearly beyond the means of their official salaries. The case of Yang Dakai, a junior official nicknamed Brother Wristwatch after being photographed wearing 11 different luxury watches, became a cautionary tale. He was sentenced to 14 years in prison for corruption. The government's efforts have continued and adapted. In May 2024, authorities took the modern step of cracking down on wealth flaunting by banning several prominent online influencers known for their lavish lifestyles from social media platforms. The unambiguous message to the public is ostentatious displays of wealth are not only discouraged, they are now subject to censorship and punishment. The combination of economic anxiety from the bottom up and political pressure from the top down has catalyzed a profound cultural shift. The concept of luxury shaming has gained significant traction. Overt displays of wealth are no longer seen as aspirational, but are instead met with resentment and scorn. In this new climate, flaunting a Rolex has transformed from a status symbol into a social liability. As a direct consequence, consumers in China have begun to gravitate toward quiet luxury. This trend represents a move away from logo-driven, easily recognizable status symbols, the very definition of a Rolex, toward more subtle, discreet goods that emphasize craftsmanship, quality, and taste over brand visibility. In this environment, an item as conspicuous as a Rolex places its owner in a precarious position, making them a potential target for both official scrutiny about the source of their wealth and public condemnation for being out of touch. The decision to sell a Rolex, therefore, transcends a simple financial calculation. It becomes a calculated act of personal risk management. But the market needed a final push, a single catalyst to turn the sell-off into a full-blown crisis of confidence. In early 2025, that event allegedly happened. It became known as the China leak. According to reports, a set of documents was posted and rapidly circulated on social media platforms. These documents were allegedly internal Rolex files that exposed the company's production costs with shocking transparency. What they allegedly revealed was inflammatory. First, the leak reportedly exposed that the markup on Rolex watches was between 85% and 90% over their manufacturing expenses. For a consumer base already feeling the strain of a slowing economy and growing resentful of wealth inequality, this information suggested that the premium prices they were paying were not solely for priceless Swiss craftsmanship, but were largely for the brand name itself. But it got worse. This initial leak was reportedly compounded by further revelations. Grainy images and videos said to have originated from warehouses in Shenzhen allegedly showed vast stockpiles of Rolex parts stacked high. This evidence directly contradicted the brand's carefully managed narrative of scarcity and limited production. It suggested that the infamous waitlists were not an organic result of overwhelming demand, but a deliberate corporate strategy to create artificial scarcity and drive up prices. The backlash in the Chinese market was reportedly swift and furious. Consumers felt they had been exploited, that the brand's mythology was a fairy tale, and that the high prices were based more on marketing pixie dust than on the intrinsic value of the product. This leak didn't create the discontent, but it weaponized it. It provided a concrete, emotionally resonant narrative, "We are being cheated," that gave consumers a powerful, righteous justification to divest from the brand. The decision to sell a Rolex was no longer just a prudent financial move. It became an act of protest against a brand perceived as dishonest and exploitative. The consumer outrage was allegedly so severe that it forced Rolex to take an unprecedented and, for a brand of its stature, unthinkable step. According to multiple reports, Rolex issued price cuts of 10 to 20% on certain popular steel models, a move specifically designed to calm the anger in what was its most important market. For a brand that has built its entire modern identity on a foundation of unwavering price integrity, this alleged capitulation represented what one analysis called a total strategic defeat. This episode shattered the two foundational pillars of the Rolex myth. The financial myth, which posits that a Rolex is a guaranteed investment, was already collapsing. The China leak, by reducing the watch to a set of production costs and supply chain logistics, shattered the origin myth, the idea that each watch is the product of pure, priceless Swiss craftsmanship, created in limited numbers. Both of the brand's foundational narratives collapsed almost simultaneously. The crisis that began in China is not a contained regional issue. It is now everyone's problem. The modern luxury watch market is a deeply interconnected global ecosystem. For years, the primary engine driving global Rolex prices into a speculative bubble was the China-centric grey market. This network of unofficial dealers operated on a simple arbitrage model. They would acquire new, in-demand watches from authorized dealers in regions with lower effective prices, such as Japan, where a weak yen created significant price disparities. They would then flip or resell these watches in mainland China and Hong Kong for a substantial premium. This constant flow acted like a massive vacuum, sucking up supply from the rest of the world and creating the very scarcity that fueled the global price boom. A collector in New York or London was, in effect, bidding against the immense buying power of the Chinese grey market. Now, with the collapse of Chinese demand, this powerful engine has not just stalled, it has gone into reverse. The arbitrage opportunity has vanished. Watches that were once destined for China are being rerouted or, in many cases, sold back into other markets. This is dramatically increasing the available supply of pre-owned watches globally, putting further downward pressure on prices everywhere. The number of used watches available has been steadily rising, and as dealers find themselves with excess inventory, they are forced to cut prices to chase sales. This is the global secondary market collapse. During the 2020 to 2022 pandemic frenzy, the average price of a pre-owned Rolex nearly doubled in less than 2 years, rising from approximately $8,900 to an extraordinary peak of over $17,200 in March 2022. Certain models became pure trophy assets. The stainless steel Daytona peaked at a staggering $53,911, nearly 4 times its official retail price. As of late 2023, the Bloomberg Subdial Watch Index, which tracks the 50 most traded luxury watch models, had fallen a staggering 42% from its April 2022 peak. A mid-2024 report from Morgan Stanley noted the 9th consecutive quarterly decline. In that period, the index for used Rolex models dropped 2.2%, while Patek Philippe and Audemars Piguet experienced even steeper declines of 6.5% and 7.4%, respectively. Let's look at the data for the most iconic steel models. The Daytona, down from its peak of over $53,000 to around $28,800. That's a collapse of roughly 46.5%. The Submariner date, down from a peak of nearly $19,000 to under $15,000, a drop of about 21.7%. The GMT Master The Pepsi, down from a peak of around $30,000 to under $25,000, a drop of about 17.8%. This isn't financial advice, but it is a market reality. The central pillar of the modern Rolex brand narrative, the idea that its watches are a guaranteed, ever-appreciating investment, is broken. That myth was simply a product of a specific, highly unusual set of economic circumstances. According to watch charts, the percentage of Rolex models trading above their official retail price has fallen from 72% a year ago to just 63% today. As one report said, the value retention myth is starting to crack. On the popular Chinese social media platform Xiaohongshu, the hashtag #Rolex price drop has garnered over 73,000 views. This reality creates a death spiral for the brand's retail strategy. Morgan Stanley analysts have noted the increasingly symbiotic relationship between second-hand prices and prices of new watches. During the boom, sky-high secondary prices created immense demand for new watches, as getting one from an authorized dealer was an instant, guaranteed profit. Now, with secondary prices falling, in some cases approaching or even dipping below retail, the entire logic of the waitlist system collapses. Why would a consumer wait years for the privilege of buying a new watch, when they can purchase the same model immediately on the pre-owned market for a similar or even lower price? This dynamic is an existential threat to Rolex's primary market sales strategy and its carefully cultivated image of scarcity. This brings us to the provocative thesis: should you be dumping your Rolex too? We must be clear, The era of guaranteed, astronomical short-term returns on common stainless steel Rolex models is over. The watch can no longer be prudently viewed as a speculative financial instrument to be flipped for quick profits. The argument for divesting from Rolex as an investment is compelling. The extreme volatility demonstrated by the Daytona's crash reveals that the asset is subject to speculative manias and painful corrections, making it a risky proposition. The core narrative of scarcity, a key pillar of its value, has been significantly damaged by the China leak, and the market dynamics that suggest scarcity is a manufactured marketing strategy. Most importantly, the key metrics of value retention have weakened. The fundamental promise that a Rolex will hold its value in the short to medium term has been broken. Finally, the global cultural shift toward quiet luxury poses a long-term risk to a brand whose primary identity is built on conspicuous branding. However, the case for Rolex's enduring value is equally strong, grounded in a century of history, if you have a long-time horizon. Over a 10 to 15-year period, the brand has demonstrated remarkable and consistent appreciation. Comprehensive sales data shows that certain models have increased in value by over 550% in 15 years. The Knight Frank Luxury Investment Index confirms this, showing watches as a top-performing category over the last decade with a 138% increase in value, outperforming many traditional investments. This performance is underwritten by the brand's tangible commitment to quality. Rolex's use of superior proprietary materials like 904L oyster steel and its robust, reliable in-house movements provide a foundation of intrinsic value that exists independently of market hype. Historically, this tangible quality has made Rolex watches a resilient, physical store of value. To truly assess its worth, one must look beyond the investment thesis. For a great many owners, a Rolex is not an asset to be tracked on a spreadsheet, but a deeply personal object. It remains an ultimate symbol of achievement. Across the world, a Rolex is frequently purchased to commemorate a significant life milestone, a graduation, a major promotion, a successful business venture, or a well-earned retirement. In this context, its value is not measured by its resale price, but by the personal story it represents. Furthermore, owning a Rolex offers a connection to a rich heritage and a timeless design language. This durability, both in design and construction, underpins its role as a legacy item, an object to be passed down through generations. For these buyers, dumping their watch is not an option, because its true value was never financial in the first place. So here is the final verdict. The crisis that engulfed the Rolex market in China was not an anomaly. It signals the end of an era defined by the hyper-financialization of luxury goods, where brand names became speculative tickers and craftsmanship was secondary to resale value. The market is now undergoing a necessary and painful return to more fundamental values. A renewed appreciation for true craftsmanship, a demand for authentic brand heritage, and a focus on personal significance over public signaling. For those who purchased a Rolex at the peak of the speculative frenzy, viewing it as a short-term trade to be flipped for a quick profit, dumping it, even at a loss, may be a rational financial decision to exit a volatile and unpredictable market. The game has changed, and the promise of easy money has evaporated. However, for the long-term holder, the enthusiast, or the individual who bought a Rolex for its intrinsic qualities, the current market correction may represent something else entirely: a buying opportunity. The fundamental value of the watch, its engineering, its history, its durability, has not changed, even as its market price has fluctuated wildly. The key lesson that the Chinese market has taught the world is this: one must separate the price from the value. The Rolex crown, as a symbol of guaranteed financial appreciation, has been undeniably tarnished. But the underlying watch, as a benchmark of quality and a piece of horological history, remains intact. When the hype dies, only true substance remains. So I want to know your take. In this new post-hype world, which brand do you believe offers the best real substance for the money? Let me know in the comments.